Anchor Sasha, good afternoon. In breaking financial news, the Federal Reserve has cut interest rates for the third and final time this year, reducing the benchmark rate by a quarter point to a range of 4.25 to 4.5%. This decision signals a cautious pivot in the Fed's strategy as it navigates persistent inflation and a resilient economy. The rate cut marks a significant shift from just 2 years ago when inflation soared to over twice its current level. Despite concerns that aggressive rate hikes could trigger a recession, the U.S. economy has defied expectations. Inflation has cooled, the job market has stabilized, and consumer spending remains robust. Fed Chair Jerome Powell described this latest decision as a closer call and emphasized that future rate reductions are not guaranteed. Policymakers project interest rates will fall gradually, reaching 3.9% in 2025 and leveling off at 3.4% in 2026. However, Powell warned against overcorrecting too quickly, as cutting rates too far could reignite inflationary pressures. Inflation, particularly in areas like housing and insurance, remains stubborn. The Fed now expects inflation to end 2025 at 2.5%, above their 2% target. In response, officials have lowered their projections for future rate cuts, anticipating just 2 in 2025, compared to 4 previously forecasted. Markets have reacted sharply to today's announcement. The S&P 500 and the Russell 2000 both slipped, while the U.S. dollar posted its largest single-day gain since last month's presidential election. Powell noted that the economy is performing substantially better than many of its global peers, with no signs of an imminent recession. Still, as the Fed approaches what it calls the neutral rate, where interest rates neither stimulate nor restrict growth, its strategy remains firmly tied to incoming economic data. Stay tuned for more updates on this developing story.